This lecture is on making capital investment decisions. I'm your professor, Dr. Stephen Haggard. The first thing we want to make sure that we do is to use real cash flows, not accounting numbers. Why is that the case? Well, accounting numbers have non-cash expenses like depreciation and deferred taxes. Those don't represent real cash outflows. Also, accounts payable represents cash not yet paid, and accounts receivable represents cash not yet received, yet net income treats these items like the cash has already changed hands. We're going to be focused on incremental cash flows in our capital budgeting exercises. What do we mean by incremental cash flows? Well, these are cash flows that will change only if we make the investment. If we have cash flows that will occur regardless of our decision on the project, we will not include them. And if we have cash flows that could happen if we reject the project, we do include them. Now this may sound a little strange right now, but we'll make it clear to you shortly. Here's the acid test. Ask yourself, will my decision on the project impact this cash flow? If the answer is yes, it is an incremental cash flow. And you're really only interested in the difference. If it would have been 100 otherwise, and now it will be 150, the incremental portion is 50. Now we're going to work through a series of different cash flows and determine whether or not they are incremental. Our first is something called the sunk cost. Sunk costs are money that's already been spent that we cannot get back regardless of the project decision. Sunk costs are not included in our analysis. Why not? Well, this is money that we've spent and our decision is not going to have any impact on it. And remember that only cash flows that change as a result of our decision are considered incremental and are included in our analysis. So what are some examples of sunk costs? Well, classic example is a marketing survey or a marketing study. For instance, you spend $10,000 to find out whether or not people would be interested in buying your product. If the answer is yes, and then you proceed to do an NPV analysis, you should not include the cost of the marketing survey, because after all, you would have already spent that money even if the answer was no. Think about it this way. If you tell a marketing person that you will pay them $10,000 for a marketing study that tells you to take on a project and nothing for one that tells you to avoid the project, what kind of answer are you always going to get? So you're going to spend that money regardless. Another one would be an environmental impact study. We need to do an environmental impact study, sometimes it's required by a government, and it comes out positive that we can go ahead and do the project. We should not include the cost of the study in our analysis because we would have had to have done the study either way, and there's no way to get our money back if we reject the project. Next, we'll talk about opportunity costs. You incur opportunity costs every day without even realizing it. That nap you took yesterday afternoon might have seemed costless at the time, but what else could you have done with that time? That foregone activity is an opportunity cost. So when we choose to invest in a project, we prevent ourselves from being able to do things that we otherwise could have done, and that results in opportunity costs. The most common examples are buildings or machines that the firm already owns that could be sold if you did not accept the project. Therefore, these costs are incremental, and we always include opportunity costs in our analysis. Another common thing we see with projects are things called side effects. If your project causes the cash flows in other projects to either increase or decrease, we must consider those changes in cash flow in the current project. And there's really two ways this can happen. The first one is good. It's called synergy, and that's when the project causes an increase in the cash flows of another project. Example, the iPod. They invented the iPod after already inventing iTunes. and immediately saw an increase in the sale of music through iTunes because now there was a way for you to take your computerized digital music with you. The other side of this coin is called erosion or cannibalism, and this is the bad side. That's when the project causes a decrease in another project. Example, the introduction of the Camaro convertible undoubtedly cost some sales of the regular hardtop coupe. Please see the two-part video posted in the same location at which you found this video for the Baldwin Company capital budgeting example. Now we're going to talk about the impact of inflation on capital budgeting. There are two ways we can look at any discount rate or cash flow. We can either have it in real terms or in nominal terms. Now for cash flows, real terms mean that all cash flows are in time $0 and represent constant purchasing power dollars. In other words, if I can buy a pizza for $10 at time 0, I should also be able to buy that pizza for $10 in time 7 if those cash flows are in real terms. However, most of the time we work in nominal terms, and that means we're talking about an actual number of dollars to be received, even though the purchasing power of those dollars might be diminished. Similarly, discount rates can be stated in either real terms or nominal terms. And a discount rate that's stated in real terms is basically talking about what kind of increase in purchasing power you would need to receive in return for the risk that you're taking on, whereas discount rates stated in nominal terms have the real portion in them as well as an expectation for inflation. So what's the rule for dealing with these things? Well, we always discount real cash flows with real rates and nominal cash flows with nominal rates. The great majority of the cash flows that you're going to see in these capital budgeting projects are nominal cash flows. So what I recommend that you do is to convert real rates and cash flows to nominal. By the way, the rates that we work with are going to be primarily nominal too, because after all, that's what we observe in the real world. We observe nominal rates. We would have to back calculate to determine what the appropriate real rate was. How do we convert between real and nominal rates? Well, we're going to use that Fisher effect from chapter 5. Remember, that's the bond chapter. And we can convert real cash flows to nominal cash flows by multiplying by 1 plus inflation to the t power. Now, how does that work? Say we're in period 1 and we are having inflation of 10%. I would multiply that period 1 real cash flow by 1 plus 0.10 to the first power. In other words, multiply by 1.10. Now if I had a period 2 cash flow and the inflation was 10%, I would multiply by 1.10 to the second power, or 1.21. In this way I can convert all the real cash flows into nominal cash flows. Now we're going to shift gears a little bit and talk about something called investments of unequal lives. Now sometimes you know that you need to buy a new machine and you go out and you look at different machines, and even though different machines will do the exact same job, there will be differences between the two. For instance, they may have different expected lives, or they may have different maintenance costs or different amounts of investment to begin with. And so this makes it a little difficult to choose between the two. If the lives were the same length, we would simply buy the machine with the highest NPV, but different lengths of lives make this potentially unwise, as we'll see in our example. So how do we do this analysis? Well, we have to first of all assume that the revenues for both are the same. Remember, we said that they're going to be doing the same job. So we're only going to examine costs, and we're going to calculate something called the equivalent annual cost, or EAC, for both. And then we're going to choose the machine with the lowest EAC. Here is our equivalent annual cost example. This is a tennis ball throwing machine that a country club is thinking about purchasing. Now, the tennis ball throwing machine is for people who would like to practice their tennis swing but are not popular enough to have friends that are willing to play with them. And so this is really important for some people. So what are we looking at here? We have machine A, which costs $500 up front, and then costs $120 each year after that in maintenance and has a life of 3 years. Machine B costs $600 to begin with, but the maintenance is only $100 per year thereafter, and it lasts 4 years. And we're told that the required rate of return for something as risky as the tennis ball thrower is 10%. And so, what are we going to do here? Well, step one is to find the present value of all the cash flows for each machine. And so we're going to use the CF key on your calculator to do that. Okay, so CF keys. I want to hit CF, second, and clear work. That gets rid of everything that's in your calculator to date. Now, notice that these are all costs. Do not get confused and enter your first one as a negative and the rest as positives. This is not a true NPV analysis. We're looking at costs here. So CF0 is 500. Enter. Arrow down. C01 is 120. Enter. Arrow down. F01 is 3 because that cash flow only shows up 3 times. Now we're ready to click over to NPV, and they tell us the required rate of return is 10%. We're going to hit enter, arrow down, and compute NPV. In reality, what we've just computed is the present value of all these cash flows. Now, what do we do with that information? Well, that's what step 2 is all about. We need to find an annuity with the same present value as the cash flows. So this is when that payment that we find, that's going to be our equivalent annual cost. So how do we go about doing that? Well, we're going to use our TVM keys. But first, check this out. I'm going to hit clear once. And now that number is hanging out there where I could do something with it. I'm going to hit second and future value, which clears your time value of money worksheet. And then I'm going to put that in as my present value. I'm going to put in 10 for I per Y. We've been told that. And I'm going to put in 3 for N because I'm trying to find an annuity that has the same life as the machine and the same present value. And from there, all I'm going to do is compute the payment. And we can see that machine A has an equivalent annual cost of $321.06. Now, it says negative, but that's just a sign convention on the TI BA2 Plus. So I'm going to click the negative and I'm going to say store 1 so we can remember that number later. Now, what about the second one? Project B. Let's go with CF second clear work. And we're going to do 600 for CF0, and then we're going to do 100 for C01, arrow down. This time F01 is 4 because that cash flow shows up 4 times. Now we're ready to do NPV. Required rate of return is 10. We're going to arrow down and compute. This time the NPV, or the present value of all those cash flows, is $916.99. So I'm going to hit clear once, I'm going to hit second, clear TVM, and I'm going to enter that as my present value. Now this time N is 4 because this machine lasts 4 years, but I per Y is still 10, and I can compute the payment. The equivalent annual cost of this machine is $289.28. If you recall, the other equivalent annual cost was over $300. So which one would you choose? Well, you'd choose B, of course. It has the lower equivalent annual cost. Okay, let's talk about the general decision to replace. This, in fact, is probably the most common project analysis, and here's why. Most companies, if they've been around any length of time, have old machines or old systems, and old stuff eventually breaks and needs to be replaced. In fact, what we see is over time, the maintenance costs of older machines get higher and higher and higher. New machines have lower maintenance costs than the old machines, but of course they cost more up front because you already own the old machine. You don't have to purchase it again. Now, we replace the old machine when the cost of holding on to it for one more year is higher than the equivalent annual cost of the new machine. How are we going to figure that equivalent annual cost of the new machine? Exactly the same way we calculated it in the previous example. Now, one more thing to note. The example here assumes the revenue to be the same from both machines, similar to the tennis ball throwing machine example we looked at earlier. Okay, here we go with our replacement example. The first information that we get is about the replacement machine. It's going to cost us $9,000 in year 0. It's going to require $1,000 per year in maintenance and has a life of 8 years. In that last year, we can sell it for $2,000, and the discount rate for this project is going to be 15%. So the first thing we need to do is find out what is going to be the equivalent annual cost of that machine. And of course we do CF, second, clear work. That clears its little mind. Now CF0 is 9,000, enter, arrow down. C01 is at 1,000 per year in maintenance, enter, arrow down. Now this gets tricky. A lot of people here want to type in 8 for F01, but it's actually 7, and I'll show you why here in a second. 7, enter, arrow down. Now, in that last year, we're paying out 1,000 in maintenance, but we're receiving back 2,000 for selling the machine. And so actually the next payment is 1,000 negative, because in this case costs are positive and cash inflows are negative. And so now we should be able to go to our NPV, enter in our required rate of return, arrow down, and compute the NPV. And I'm getting $12,833.52. Okay, now hopefully you remember how to calculate equivalent annual cost. We're going to hit clear once, we're going to hit second, clear TVM, and then we're going to put that in for our present value, 15 for our I per Y, and the machine's life is 8 years, so 8 per N, and we will compute payment. And I'm getting an equivalent annual cost of basically $2,860. So I'm going to hit minus, and I'm going to store 1 because we'll need to compare against that number here in a bit. Now we need to look at the old machine and figure out what the annual cost is for holding on to it for one more year. So let's get our calculator back up here. And to hold on to this thing right now for one more year, we have to give up $4,000 right now. We'll pick up $2,500 at the end of the year, but we'll also have to pay $1,000 in maintenance. So let's see if we can work this out. First of all, let's handle that salvage value of $4,000 at time 0. If I took that $4,000 and invested it for 1 year at 15%, I would be getting $4,600 in time 1 money. Now I'd sell the machine for $2,500 there at time 1, and then I would also have to pay $1,000 in maintenance. And so the cost for me to hold on to this thing for one more year is $3,100. Let me explain that one more time. We are foregoing picking up $4,600 in salvage value at time $1 by not selling the machine at time 0. But we do get back $2,500, so that's why we did the $4,600 minus the $2,500. But then we also have the $1,000 in maintenance that we need to consider. And so that's where we get our $3,100. Now, is that greater than the equivalent annual cost of the new machine? I think it is. Let's check. Recall 1. Yes, it is. And so we would immediately replace the machine because holding on to it for one more year is more expensive than buying the new one. Now, what if we hadn't decided to replace the machine this year? A lot of times people think, well, that means that you go out in the future, you just keep going through here until you find where it's going to be more expensive. And my thoughts on that is, no, what we need to do is keep the other machine for one more year and then redo this analysis at that time. We know that numbers that are forecasted out further in time are less accurate. So the very most accurate numbers on here are for time 0, and then the least accurate are for time 4. So definitely do this every year until you figure out that it's time to replace the machine.